Is that better? There we go. Okay, sorry about that, guys. I think I got the microphone issue figured out, but it might be too loud now. Let me know if it's like burning your ears. I got this new microphone a couple weeks ago, and it's definitely a lot louder, which is nice because I don't have to like lean forward and talk right into it, but I don't want to hurt anyone's ears. So if it's super loud, tell me. I think I got rid of the echo. Let's see. Okay, yeah, we should be good. All right, so this is Red Ben. You can get a hold of me at Red Ben Trader on Twitter. And then if you have any questions about the algo that I'm using, it is based on the algo from the Trade and Perform Room, which is developed by my coach Simon. If you want to learn more about it, find out about the futures trading room he runs. There's a cost associated with the room, but it includes putting the algo on your desktop, and the value is really good. So give him an email, trade the letter N, word perform at gmail.com, and he can, if you mention that you found the room through me, he'll give you like a week free in the room. Kind of get a chance to check it out and see if it's something you want to do. As I said before, I found it super valuable. It's not for everybody, and it's a professional room where we're all there to like trade the process. So like realize that like if you're coming with a lot of old ideas, like it's fine. You can do what you want to do, but we're not like everyone's on the same page there. So there's no need for like you can kind of be there and learn as a new member. And if you have something you want to share, the key is to not post it like in the morning when we're trying to all find trades and figure things out. Like if you want to post ideas in the afternoon of like new trade signals and stuff like that, you can do that. But just realize that like it's the process is kind of already fixed, and even some of my ideas that I'm going to be sharing today aren't like I don't post them in the room because they haven't been added to the like the official algo yet. So the way this works, like I'll show you here. So what everyone in the room is seeing is similar to this, with just a few signals that have been like thoroughly back tested with specific entries and stops, and it takes a little, there's a learning curve to try to figure out like what everything, how to use it. You don't really need to know what it means, but learning how to use it does take time. But once you learn just a couple signals and the patterns, you likely will find that it's a lot easier than you think. It looks confusing, but it's really just a Renko chart with the algo basically reading the footprint and the so it's looking at this. Where's all the, here we go. So it's looking at all of this info as well as the what's it called, the volume by price, the order book, things like that. And when it finds things that we told it to look for, it indicates it. And then the hardest part, for me anyway, is learning how the algo will show you a potential signal on a live bar. Like this bar is currently live, it's not closed. We know where it will close because it's Renko, so it's not time based at all. It's just when price moves, in this case, it's 7 ticks for ES, up from the open of the last bar, or the close of the last bar, it'll be a bullish bar. And if it goes 7 ticks down, it'll be a bearish bar. And so these numbers on the right show us what those prices are that would cause the bar to close. But the dot and the star here, for instance, as well as this little dash, they can move, they can disappear or reappear when the bar is live. Once it's closed, if they're still there, they're valid and they won't disappear. But at first, because the algo is set up to like prep us for a trade, like there might, let's say you were looking for a short here and you need a triangle on a, or I'm sorry, a star on a down bar to get in. Well, you want to know that that star will appear before it actually happens. It's helpful to like be able to prep your order and say, okay, I'm going to get short at like one tick below 4507 because it looks like it's going to print a star, but you can't short now because it could go up, close bullish, and the star will not print. So it, like I said, that is the hardest thing to understand is, well, first of all, just to learn how to read Renko takes some practice, but then realizing that you need to be patient and wait for the bar to close to like properly use the signals. Because as you see, like these are going to stay the same, the ones that are in the past. And if you go back and back test and say, like, how would I do if I bought every time I got a triangle on a bar that followed a star? It'll tell you, but you can't then go here and buy just because you see a live triangle, because the back test was done with uh, closed bars that got triangles, not live bars that had the potential for a triangle. So that is something that's very confusing to a lot of people. It was confusing to me as well at first, and it took a lot of getting used to like see a signal that I practiced clicking the button with, but waiting and being like, okay, this is the level that needs to reach, then it's valid, then I can like get into the trade, or I can choose at that point to wait for a pullback. But there is no trade until the bar closes with the signal you're looking for. So like I said, this is less signals, but easier to read, easier to like process, and all of the signals have like use, they're all useful for certain things. Most of them have to do with like looking for a pattern of multiple signals or signals that appear at certain points. So like a pink triangle that shows up touching this lower line here are usually pretty strong, like touching or below. So like here's the line, here's the pink bar, and that one got a triangle. So once that closes, we can we can assume that most of the time we're going to be able to get some sort of a lift there, if not more than some sort of a lift. It's not always the bottom, but that's just an example. And then here's this one. Oh, that one didn't get the triangle, did it? The triangles on that one. So the same thing in reverse would be a purple with a triangle down. It'd be a red triangle like this associated with a purple bar that touches or is above the blue line. So we didn't get a lot of shorts on ES. That's probably good. So that would be an example of like a setup that you might learn and practice. Another really common one is an apex trap. So these blue triangles that like the one on the bottom points down and the one on the top points up, those are swing highs and swing lows. It's the only algo signal that doesn't show up right away. It shows up like 2 bars later, but we don't use it for a live signal. We use it to draw a line, because once this bar closes, let me just get rid of the too many lines here. Once the 1, 2, third bar closes, this little apex will show up, and then I can draw a line on that, and I now know, since it's a swing low, that there's liquidity sitting down there. So if they sweep up the liquidity and then in 1 bar come back in to the this range here of this bar, which they do right here, then that is an entry. And getting a triangle on the bar that comes after it in the same direction confirms that you can like hold the trade a little longer to try to get an extension. Whereas if it just does the 1 bar and then starts pulling back, you can probably just treat it as a scalp. That also works on the short side. They don't always set up and they don't always work, but here's one that does work. So this got the little apex 1, 2, 3 bars later. So once this one closes, the apex shows up. Now we know to watch above that for liquidity grabs, which happens right here. That's the down bar. And if you mark where the up was, that range needs to be returned to in one bar, which it did. So that's the short. Note you got a triangle down, so you can go ahead and hold it to your target rather than just scalping your way out. So those are, now like I said, they don't always work. Like for instance, here's one that failed. If you were shorting trend A up, you would potentially look for apex to form. You'd assume there's liquidity back here, and then you might short this right here when it comes back into that bar's range in just one bar. But because it's not bearish, they lift it, and you never get the triangle down. The very next bar lifts back up, and so you can just realize that you're probably done with the trade. The chances it's coming right here are really low, so you can get out of there for a small stop if that happens, and then you'd wait for another one. But here you can see we never took that liquidity, so if that was your only trade in your playbook, you just missed the short. Which is why it's kind of nice to have more than one trade in your playbook, but that takes time to master. The way to do this is to add them one at a time, master them, make money with them if you can, and then add trades to that so that you've got more opportunities. If instead you try to learn 10 trades in a week, you're going to get completely confused and mess them all up and not make money, most likely. So some of us, most of the members in the room, like have these signals, and maybe one or two more that he's added since I had this one saved, this layout saved. And that's all they need, and they just run their program and execute when it tells them to execute and do pretty well. Some of us are a little like extra, and we like to do the actual testing to see if we can find more setups. And I'm one of those members that really enjoys searching for new setups and back testing old setups to see if they are still performing well, and determining if I need to add or remove any rules for when that trade is valid. So to do that, I have multiple different layouts with more signals than most. Probably more than it's definitely more than I need. And then on another screen, I've got what's actually a simplified version of the same thing, which is much closer to Simon's with just a few extra signals. But oftentimes, if I just added a new signal, like I did last week, I will start by putting all of the indicators on and not hiding really anything that I'm actually using, because that way, especially upon review, like maybe not when I'm live trading, all I would really need is this. But if I'm reviewing, I want to see where everything is, because that way I can identify the patterns more quickly. Because if I hide like the diamonds, then I'm not going to know that that bar had a diamond when I go back and review. If it's hidden, I won't see it, and I might not recognize that pattern. But like I said, if I'm live trading, I don't want too many signals, because otherwise you're not going to be able to make any decisions. You're just going to get into like analysis paralysis. So you don't really want all, if you're like me and you like to add new signals, you need to well, it's fine. You need to make sure that you're only trading with the ones that you've already confirmed have an edge. Maybe that seems obvious, but it's something I still make a mistake with. I get so excited about seeing a pattern that I think might be good, and I will like try it out for a day or two with like the apex evaluations, and it'll work for a bit and then it'll stop working, and I realize that like, okay, it's not refined enough, so I need to go back to the drawing board and see what I'm missing here. Is it the environment? Is the code not quite right? Or like do I just need like an additional filter, which is, like I said, why I tend to have all of the algos showing, even though I know it's very overwhelming. it like visually, if you don't know what any of these means, it becomes hard to even read the price action the more signals you have. But when, I've been doing this for 2 years now with the algo, so like if I'm only looking at this, I can still see the market very easily. I can still see the setups. It still works, but I just end up sitting on my hands a long time because there's not a lot of setups. There's enough to make good money, but there's not. To be honest, the real problem for me with having so few signals is I get bored. So it's fine to be bored when you're trading as long as you know what to wait for. Like I said, that's why I have a chart on a different screen with less signals, only the ones I'm actually already confirmed and using, and then I can use a different screen to show some of the new ideas so that I can find new setups and then test them once I identify them. But like I said, you won't see the pattern if you don't have them showing. So we're going to look at all of them for now, but I know that since nobody knows what they all mean, it'll be overwhelming, but I can point out some of the patterns that I recognize if they show up. And then, like I said, when we go back and review, I can kind of break down like what I see based on all the signals. And many times, like the signal will be there, but like it won't be all that useful in that situation. But I'm not hiding it because there may be something I just don't know about, where like if you get like for instance, a very good continuation setup is if you get a star going against the trend and then an X going with the trend, as well as a star going against the trend followed by a diamond going with the trend. So like you don't need that trade to find a setup, but having them there means that I won't miss the continuation trade, which is kind of cool. But if you're not trending, you can't take that trade. So if you're catching yourself taking trades that you shouldn't, the easiest way to fix that is to have a layout that's only for trend days, and then have a layout that you use when it's not trending on a different screen, and just don't even see the algos that like are really just for trend continuation, because you you won't be able to, you might have a hard time determining whether or not you should be paying attention to it or not. Hold on real quick. So, then the reason I've got multiple layouts here is these are actually different Renko sizes. So the one on the right takes the longest to print. That we need 40, I believe. Yeah, 40 ticks in one direction to print a new bar. So you're not going to get as many bars. And then the smallest one I'm using is a 15 tick, so you're going to get a lot of bars in here with more signals. The only reason you need more than one is, well, I guess there's two. One reason is when the market changes speed, if it goes really fast, I'm not able to process all the information in time. I mean, it's a hell of a lot harder to do it with all of this information, but even with just looking for patterns, it can go so fast that you can't even, like, by the time you see the signal, you've already missed the entry. If that's happening, you need to go to a higher time frame. So I have the 15 tick, which is like usually my like scalping chart, and these are all NQ. That's what I focus on primarily. And then I've got a 24 tick, which is like slow enough where I can pretty much always trust that I can process that information. So if I see a pattern on the 24 tick, it's definitely worth taking. And then I have the 40 tick showing, and then I also have a like 67 tick that I hide but occasionally look at, so that I can see the bigger picture and make sure I'm not missing a signal or a pattern on this higher time frame. For instance, I might not notice on the 24 tick that this momentum is slowing down. You might see it, but if you don't, the 40 tick put a star and an X, two signs of aggression, right at the top. So trapping him with a bar that's not purple. So if we get a bear bar like this color here, underneath that dot, most likely this is now resistance because that aggressive trader got trapped. If it's just purple bars below it, though, the purple suggests that it's price is dropping, but it's dropping due to a lack of liquidity. It's not new sellers necessarily pushing price down. It's buyers pulling their orders off the order book where like they thought they were interested maybe, or they're spoofing, but most of the time it's that they thought they were interested if price dropped, but something they saw made them decide not to take that trade, so they pulled their order out, and the result is you don't need very much like power to push the market down when it's purple. So while that might sound bearish because people are pulling their buy orders and price is dropping, it is on a very short time frame, but a lot of times the very best setups occur when you get the purple bars and then you get over them, because what it basically shows is people were giving up, buyers were giving up, yet we went lower and there weren't any sellers, and so buyers changed their mind and decided to come back in aggressively. So and that works on any time frame. So like on this time frame, it's already looking bearish, right? Like we're already testing this support. But if I look at the higher time frame, I can see like, okay, yeah, if we get under that with real sellers, then yes, it's probably bearish for a little bit, and it makes sense that we'd retrace this because these colored bars suggest that it was a little bit overcooked, but it doesn't have to. Like price can just keep going. Like you can't just assume that it's always going to pull back. And even if it does pull back, if they don't show any aggression here, if we just get purple, 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 all it'll take is one big trader basically to just aggressively squeeze all the way back up. So while we got regular bear bars here, meaning on this time frame we're probably going to be able to get a little bit of a dip that's definitely sellable, we have to keep our eye on the higher time frame. And if all they can put down here is purple bars, it's not going to stick. The buyers are going to take advantage of that because it looks weak. Like, why aren't there new sellers coming in to push the market lower when buyers are giving up? The expectations, if it's so bearish, then we should get big sellers down here. When they don't show up, buyers start showing up instead. And so you'll see here, if this can come all the way back up and close bullish, most likely it's not going lower for the moment. So this triangle up here is technically a long, if you're at support, and I mean, we're at higher time frame support. On this tiny time frame, it's probably a little early, but technically, if you thought it was bullish and you were at support, getting that star following, getting purple bar, star, triangle up, that 3-bar combo is usually pretty strong. And then in that case, your stop would go down here underneath that swing low. See how my swing low apexes look a little different than Simon's. Mine goes sideways because my brain gets confused with all the triangles. I can't process them when they only go up and down. So I don't want to get confused from these triangles. So my apexes go sideways. I call them flags because they kind of look like little flag poles and flags. Yeah, normally if this is bullish, we're going to get continuation here, but you can see after the triangle, we did see an aggressive trader try to sell here. So now we're going to have to trap him, which could totally happen. But again, we see over on this side that they need to reach 51.75 to close this bar. And if they can't do it, it suggests that sellers are actually following through, and then it really is bearish, even on a higher time frame. There we go. Oh, didn't close yet. It's still sitting in that old, that green, it comes from the profile, and it's previous single prints. So it makes sense to see some support there. They're trying to save those single prints. They've already been traded through earlier in the day, but I leave them on there because they tend to continue to react to them, but they don't always. It's usually the first test back in that really matters. Okay, so there's the close. So now we've gotten a real bear bar underneath this aggressive trader on a higher time frame. So my assumption at this point is that these guys are now trapped and pullbacks into here can probably be shorted. The problem with shorting on a day like this is you have to be realistic about your target. So because there's probably sellers that are trapped lower, and if we return to their entry point, they could definitely just cover and like pause the drop. So whenever you have a trend day, while it, yes, 10% of the time, let's say, it can turn and reverse the entire thing. That is definitely the exception and not the rule. Generally, what happens is you actually end up closing at the highs, or at least not back at the open. Particularly if you have, here, I'll show you. So on the big time frame, here's overnight, see how we had this is basically a huge gap. This is overnight, the brown. And so we got this big gap. That's overnight range. And then we opened up here. They pushed higher. They pushed back in to the overnight range, about a 50% retracement, and they couldn't get the low. So not only are these sellers trapped, but like this guy here with the diamond, he got an opportunity to get out of his short and probably did and lifted the market up. But then now they're getting stuck here. So rather than seeing this as like a failed breakout that's probably going to reverse the entire day, what I prefer to see is that we basically have momentum because of trap traders. They tried to pull back. They ran into those offsides traders, and those offside sellers became buyers. They pushed back up. They ran into some resistance where some volume was put in at the top. Those guys are short-term traders trying to buy the breakout that basically got trapped on a tiny time frame, like an intraday. And so what you end up getting is consolidation, because you've got sellers trapped underneath you and buyers trapped above you. Now, the way to determine which direction that consolidation is likely to break out is you need to look at the higher time frame above you and ask, do I have buyers trapped to the left of me that are going to act as extra weight when we try to come back up, or are the only trap buyers the intraday? If it's just intraday, the chances that this low gets like pummeled hard, you can test it, but the chances that we're going to find sellers underneath this is actually really low. And like I said, that's not what people want to hear, because the exciting trade is to sell this and see it come all the way back into yesterday's range. It's just rare. So usually, like, one of the reasons we use the Keltner channel is the blue, and then the gray on mine is the mid, is that in a neutral market, most of the volume should occur inside of those blue lines. Well, you can see here, this was not a neutral market, which is why Simon's he's a big advocate of not using overbought, oversold, because it's useless, like, jargon. Like, overbought can just mean bullish. It's not a problem until there are sellers taking advantage of it. But you can see we were quote unquote overbought, and all it did is just corrected back to the point where neutral markets usually spend all their volume and time, and then immediately came back to the high of the Keltner channel, and now the mid is basically acting as support, most likely. So this is bullish to neutral behavior. This is not a bearish chart. So assuming that this low has to go because we've got trap traders on a tiny time frame up here, it's just illogical, basically. So you always want to be aware of what's going on the higher time frame. Now, we did get ring, triangle down, ring, triangle down. That, if it's bearish, that is a good entry to sell. So we may not be done yet with this drop. It's not necessarily just going to go straight to the high, because that is a powerful entry. And but the idea that this low has to be taken out because someone's trapped up here, it's just not the way it works, because on the way up here, we trap so many sellers that they are forced basically to buy down here. So yes, we could get more of a pullback, but chances are it won't be severe. And therefore, if you want to trade into the close, the better trade is to trap a seller down here and then try to rip above them. Now here we would need to close a bar above this bar to really think that we're going to go straight up. A lot of the times that's not how it works. Oftentimes it kind of does one of these, like little W's. Here I can get rid of that other. We don't need that. I was using that for likely resistance, but that already worked. So ring, and if we get triangle down, that would be what you usually see in a, it would, like on a high, lower, is it a lower high? It's actually a higher high. It probably won't happen. They probably will just crush him. Let's see. Remember, this is a very small time frame, so we can easily bounce around in here and still be bullish on the higher time frame. But what I'm looking at is this high got taken out. In other words, there's liquidity up here. And so if it's bearish, it goes lower. When it's not bearish, it doesn't. So they couldn't get it to go lower. I get a blue dot, which is technically a buy, and I could scalp that to the upside if I want to. It's the problem with doing that is, I mean, it's not bad. It's actually a pretty good trade normally, but you have to make sure that you have room to the upside. I didn't get to my dom fast enough to take it, but that would be an example of a like a late pullback entry. I'd prefer, this is actually a better entry, the pink bar with the triangle up that's above the purple bar, and above a dash is even better. So that is my preferred entry. But if I'm looking for a late entry, the way to do it is to get above one of these heavy hitters, like the rings, the stars or whatever, and then on a higher high, like basically take out liquidity and then see what they do. If it's bearish, they're going to take it down. So when they don't, I get a blue dot that tells me, yeah, you can go ahead and chase this a little bit. It's only a scalp. I'd be out right here, basically, like just taking whatever that is, 10 points, let's say, is usually what I target. So I wouldn't need it to go to high a day. And then your stop goes under the blue dot. So like in this case, I'd be getting long maybe 44.50, 45, and my stop would go under the blue dot. So like 36.50, let's say. So it's, you could say it's a 10-point stop. And so I want to get 1-to-1 on it, and I would have gotten filled. I just was talking and didn't notice it fast enough. But you can see how, like, if you're not dialed in, this 15 tick is, you got to be quick. Because that trade happened in like 2 minutes. You had to be in and out in 2 minutes, basically, at least out of most of your trade. If you want to leave a trailer, since we're trending up, it's not wrong to leave a trailer. But when I get in this late, if I got in back here where I really want to, where the arrow is, I'm definitely holding a runner. But if I get in here, even though my risk looks pretty small, it's only 10 points, whereas here you have to put your stop under the swing low, so that's more like 15 points. Here I'm willing to hold a runner because I can withstand a normal pullback without coming anywhere near my stop. Well, if I get in here and we get a pullback, it could actually get under my stop and then just lift again. And I don't know about you, but that's really frustrating for me to like get into a trade, have an opportunity to exit for a pretty decent, like, I mean, 10 points with 2 contracts, like that's $400 for a single trade that took 2 minutes. So like, why not just take it, in my opinion, if you're getting in that late? Well, the way I say it is, if you're aggressively entering, you should aggressively exit. But if you passively and patiently entered, and you're going with the trend, then yeah, hold it. You might end up getting 40 points. And this could keep going. Like, I'm not saying it can't. The problem with holding a runner for me beyond 10 points is, like I said, there's so many times where it actually pulls back and it's going to set up again anyway, but only after taking my stop. And while you can still make money doing that, like you can get out 1, let 1 pull you back, and then get in 2, and then get out 1 and hold the other one, because now you've got a better entry on a pullback. Yeah, a lot of times it's just psychologically it's so difficult to deal with like the back and forth and back and forth. I was up, I was down, I was up, I was down. And then if you miss an entry and it just goes, like I'll tilt so fast because it's like I'll see it and think like, wow, why wasn't I in that? But if I have a good reason for exiting and it keeps going, no, that's fine. I'm okay with that because that's not my trade, right? Like my trade, the trade that I know works in that situation is to take the 10 points. And then sometimes it keeps going. It's kind of like in blackjack. If you ever played blackjack, like you can hit with like 20. Okay, maybe not 20. You can you can hit with 18, and it doesn't mean you're always going to lose. But over time, like your expected value is negative because most of the time you're actually going to give back or lose basically. So while the 10 points there are positive expected value based on my back tests, trying to get 20, 40, whatever, and leaving my risk down there is not great. The only time it works is during a trend day when you have no resistance here, which this is. So if I was going to do it, this would be the time to do it. But normally that's not usually the way I trade it. I will hold the runner if I got in here. I will not hold the runner if I got in here. And that you just need rules. That's all I can say. You got to have rules you're willing to follow and just do it. And then over time, go back and review your execution and how did I do this week and did I follow my rules? Is it working out close to what I expect? Because past performance is not necessarily indicative of future results. We don't know if, back test that shows a 60% win rate or something. We don't have any like clear proof that that's going to happen again ever. But would I rather be going with the trade that back tested at 60% versus the trade that back tested at 30%? Hell yeah. For me, there's a difference there. But does it guarantee that it's actually going to be profitable? It doesn't. It does not. You still need to manage risk as if it's going to lose. And while that might be frustrating because it's time consuming to like get through those days where things aren't working, it's just the way trading goes. And no one's going to be green every day. But if you find a system that works most of the time and you manage risk when it doesn't, you can build your account. And rather than like trying to get some perfect entry that's like got a 80% win rate and never gives back more than 10%, like you can look for it, like, but it doesn't exist. Like it's the higher the win rate goes, basically, the bigger your risk is, because to get that kind of win rate, you need to occasionally risk a whole lot, and such as like the classic mean reversion trading. If you're willing to put your stop far enough away, and you basically like try to ride the failed breakouts back to the mid or something, most of the time it's going to work. But the problem is when it doesn't, is a day like today where like if you shorted the open because it's overbought, like I mean you'd have to know, when do I get out of this because I've given back 2 weeks of work, like trying to mean revert on a trend day. So there's no magic bullet. It's a matter of being consistent and not letting your emotions do what the market participants want it to do. Because keep in mind, like, other market participants want you to lose, right? Like, truth be told, like, this won't work for me if other people all trade optimally. But I'm not afraid to share what I'm doing because there are plenty of horrible trade setups that don't work very often. And then there's even more traders that don't even use a process that I know over time are going to lose. It's just a matter of who can like stay in the game longer. So yeah, like I don't mind sharing because if you want to put in the work and learn how to like follow a process, do it. And then you can make money trading. I'm not going to guarantee it, but you have a chance. If if you see all this and you think like, oh, that's way too much work, I know it's bullish. I'm just going to buy when I think it's bullish and get out when I'm profitable. Like that'll work for a while in certain conditions, but eventually you will either drain your account or just totally blow it up because either your emotions will get the best of you because it's not working or the market will. So either way, the important thing to remember is that the market, the participants in the market want you to go broke, right? Which is, it's nature's cruel, right? Like the natural way the market works is to fuck people. That's what it's built to do. So the question is not like, is someone losing money? It's, can I avoid losing more money than I planned on risking? So if you instead of seeing it as like winning or like not winning, if you see it more of like I have this much to spend on this likely setup that I know usually works but doesn't always, but if it takes more than this much of my capital, I'm not willing to stick with it. Sorry about the jet. I live by the Air Force Base. They like to fly right at lunchtime. So, yeah, if you don't have that risk management really solidly built into your system, like I said, the market, it's actually here to take your money, and it will. It'll, if you let it, it will. And the price action, the way the market moves, is quite literally built to put you on tilt. Like that's why the market sweeps stops. That's why the market like tests a level, starts to move, and then like makes like a fake out, right? It's not that it's some like all-knowing being. It's just that's the result of putting everybody at the same table trying to make money. The result is it's gonna do things that make people tilt and make sure that their money does not stay with them. So the only thing you can do, in my opinion, to not let the market fuck you, well, I mean, you're gonna get fucked sometimes, but like the only way to not like lose all your money in the market is to have a very clear risk management plan and a way to know when to stop running your program when it's not working, so that like when you do get fucked, it's a light fuck. Right? You don't want to make one stupid decision that gives back weeks and weeks of work. You just can't survive as a trader doing that. Yeah, and for some reason, that's a really difficult thing for most of us to really accept. And I'm totally guilty of it too, where like you expected something to happen, you got into the trade, it doesn't work, and suddenly the market participants have got you by the balls doing things that are not part of your process. And like I said, that's the game. So if you can recognize that that's the game and you see it happening, then you can have the power to stop doing that. Like you just have to stop participating when like when the tilt comes. You need to stop. So there's ring triangle down. Let's I hate shorting up here though. So that's technically a short. Let's see what happens. I'm not going to take it because I've got a blue dot right behind it. It's just not bearish enough, but that's technically a pretty strong bear entry if it's bearish. But this, just like I was just saying, this looks exactly like the type of spot that bears are going to get trapped. So let's wait and see if they trap them. And then, oh, there's only 50 minutes left. Damn. Ranted too long and missed the good trade. And yeah, that's okay. But normally, if this was neutral to bearish, that's an entry. It's not a great entry in this situation, though, because we don't have any momentum. And if anything, we have shorts trapped right here. So that'd be our target. There we go. So let's see if we can get a triangle up. I don't like the risk reward, but it's still a good trade. If we can blow through this, we can give it a try. But see, the problem is resistance is right here now. So what I really want, I want them to fail, swing under here, and then give me a triangle up, and I'll have much better. See, that's really my target is high of day, which makes sense. But this little resistance, it could technically hold. It probably won't, but it can. Now I have to wait for 63.50 to hit, and if it does, it'll fill me because it'll close at 63.25, and then I'm willing to get in. It has to actually do business at 63.25 for this triangle up to be valid. So I can't take it until that trades. So I just put a stop order at 63.50. And if it gets to 63.50, I will be long with a stop down here at like 48. There we go. Okay, so filled. Now, I don't want them to come down here, which is the problem with this setup, is that like that's actually still bullish. But yeah, I just to manage risk appropriately, I'm going to need to put my stop like 47, 48, something like that. And if the momentum's not strong enough, it's going to come down, sweep my stop, and then give me a better entry. Since I took the aggressive entry, if that happens and it triggers again, I'm forced to take the second one too, because the better trade is the second one. It doesn't always happen, but if you're concerned about it, the way to deal with it is to skip the aggressive one, wait to see if the other one sets up, and then just take that one. Wait for the trap, and then when it fails, you take that trade and you skip this one. But if you want to be aggressive, you got to take both. What you can't do is take the aggressive one and then skip the less aggressive one that's more likely to work. That's the higher win rate. The problem here is, like I said, we're trading right into resistance. So I expected some sort of a attempt to pull back, and the question is, do we have enough pressure to keep this wick from being tested? And that's questionable. So a lot of times I wouldn't even take this aggressive trade because the risk reward is so poor. But because it's a trend day, I feel like it's relatively likely that we're going to probably sweep the high. And they don't always give you the best entry. So primarily out of interest of just demonstrating how this works, I took the trade. If I wasn't up on the day, I would not take a trade at the end of the day like this. I just wouldn't do it. Because why? Like, I can just come back tomorrow when the order flow is better and yeah, just wait for the better trades. But this is a good example of like to show that like aggressive trades can work. It's just aggressive. You have to be accepting that like your win rate's going to go down, but sometimes it's going to work. And as long as I think I can get to high a day, which is like up here, then I can still get 1-to-1, that's important to me, that I can take profit at 1-to-1. And then in this situation, if I want to hold a runner, I probably can, because end of the day, pushing into the high, they could totally just scream it higher. If I didn't think that was likely, you really don't want to take the aggressive trade at all. And like I said, I would not be surprised if this stops. And it does. Oh, fuck. I forgot about market on close. That blows, because I got shit ton of slippage on that. That blows. I totally forgot. So market on close got published, and it was a sell. And so now let's see if I can get the better entry here or not. So they need to trade. Oh, no, it won't work because they can't take out this T. It's not going to be high odds unless they could close a triangle above that, and they can't. So the yeah, it's not good enough. That's too bad. If they wouldn't have put 3 bars down here and instead only 2, I'd be positioned correctly to take the long. But now I don't have a back test for how often it works when we don't reach the T. So I can't take it because I don't have any proof that it actually works. Whereas if this one didn't exist and we were already up here, I could take it. Now, it doesn't mean that it's bearish. It just means I don't have a reason to buy it. There's just no way I can get set up on this candles, on this bar. So even though it might go, now I'd end up missing it. And like I said, that is the risk of taking the aggressive trade. Had I remembered that we actually have market on close at 50 after, I wouldn't have taken it. I completely forgot that illiquidity exists, which, like I said, just because I'm distracting, I wasn't even looking at the clock. Had I noticed that it was getting that close to market on close, I would have actually exited the trade, because the problem is my stop was here, but they filled me here. And that's just the risk with being in the market at illiquid times. And that's just a blunder on my part, just a trade execution error. So like I said, I would not be surprised if they rip this higher. That's kind of what I expect to happen, but I can't find a great reason. We did get above this T, but this one's probably going to act as resistance. So I just don't have a way to get long. It's too bad. If they push and trap back in, then I can get long, but I can't buy this bar. There's just no setup here to get me long yet. So, and I'm not going to short into the end of the day on a trend day up. That doesn't work very often. So the T over here, we would expect to act as support, and see how they can't get the VPOC, the yellow line below it. It suggests that it's bullish, but there's a T right here that could do the exact same thing on the opposite side. So it's like you're just stuck here basically with no edge. So nothing to do, which is honestly usually how, like, the opportunities in the market, like even this, just like the regular trading hours, they're thin. Like, if you're constantly pushing the button, you're probably taking trades that don't have an edge, probably. And like, I've got a lot of setups I can take. So like, if there's literally zero setup here, yeah, it's probably not a good idea to trade that. Doesn't mean it's not going to work. I just don't have a reason to take it. But see, okay, that one would normally be an entry if I didn't have this T here. But the idea is the T's tend to act like support and resistance. See that? So we don't know if they're actually going to attack it or not, but they could. So I don't want to get in unless I've gotten over him. But by the time I do, I've already moved pretty far from this is going to be an apex as soon as we close this. It takes 3 bars. See that how it just shows up late? That's normal. It's the only algo that does that, but that's the way it works. So now if I get a trap back in under this, if we go down and we come back in within 1 bull bar, I could buy it. But other than that, nothing to do as far as I can tell, because now we're just trading right into the, see, this is where all the volume is right here. That's where all the volume is in this chunk, if you will. So normally consolidation is gonna occur in here, but it's the end of the day, so they might not care and just rip it up, because there's probably so many bears trapped. And someone shorted this when I got stopped out. Someone shorted down there too, so they could easily get screwed right here. Wouldn't be surprised. Glad I didn't take that not entry though, because you can see how they're messing with you. And this is why it's so important to have your rules really clear, because if you just said buy every triangle, like, you're not going to get the win rate that most of us have. You need more rules than that. There is a decent rule that if you have a purple bar that's beat by a triangle,
that's usually bullish, but it's really only to get 1, maybe 2 bars. So if you do get in here, you'd have to get out right there. So it's not necessarily a 1-to-1 risk reward if you don't think there's a good chance that it can break out. And at that point, once they already did this pullback, I didn't really have a reason to think it would. Like I said, if one of these bars didn't exist and we were tighter up here, it would be easier to break out. But now we're going to need to expand the range first. So let's see if they can get down here and then trap back in, and that would be the opportunity for a long. But notice that, like, I'm not, even if it wasn't the end of the day, I would not be looking for a short here because there's too many bears trapped underneath us. Even though this looks like, oh, the trend is over, the trend day ended, it's going to go back to the open, like, it just doesn't do that very often. I hate to say it. I mean, when it does, it's exciting, so we all remember it, but that's not usually how this works. Usually, the higher time frame, like after the gap, those who are swing trading options, they're way off size. And so if they haven't covered yet, the moment we get any momentum started, they're just going to lift it because they're kind of forced to, just to manage risk. Note that where all the volume was here is now the support, and that's bullish. So if that continues, like, it can get under it, but it's got to defend it. So here we might get an opportunity. How much time do I have? I'll actually look at the clock this time. All right, we have 3 minutes. Gross. It's got to get under this. It can't just double bottom. It's got to trade under it because I have to believe that somebody got stopped out. There we go. Now they did. So now the guy that bought here, like me that didn't follow their rules and bought here, just got stopped out, right? And so now if it lifts, I would expect that same trader will chase it up, and anybody who's shorted down here has to cover. So now if I get triangle up, it's much better because I've gotten a long stopped out. See that? And the diamonds mean there's a lot of volume here, primarily because it's the end of the day. But still, if we can recover that volume, the sellers are going to be very uncomfortable. But note, they have a bunch of volume down here too. That's the bear version of the high volume bar. So they may try to push this further. And if we get far enough that we can't reach this low with 1 bar, the sellers are going to take over. But like I said, I doubt that'll happen, but it might. Always a possibility. You never know. It was also high volume on the 24 tick. But see here, that's this guy on the higher time frame is trapped. I mentioned that before, I believe. So what would make sense is to come back to his VPOC where that dash is and then bounce. And if this low gets taken out, we can get a trap back in there too. But there won't be time to buy it if that happens. So we're getting star, and then they want triangle down. If it's bearish, they will continue lower. So whenever I see things like that, where it's like, hey, if this is bearish, this is the start of it. Well, if it then doesn't go down, it's not bearish. Okay, so they definitely took those stops. So let's see if they can fling back up. And then if we can get a triangle up, we close in a minute. That sucks. Oh. Should I or shouldn't I? We really do the triangle. I can trade 15 minutes, I believe, after the nice ring. So 48.50 would be the entry to try to squeeze this up post-market. And I got fill. Let's see if it works. So my stop needs to go down here. It's 36. We'll do under 35. Give me a little bit of wiggle room. Let's see if we can break through this and get my money back. The pink bars at the end is interesting. It means sellers are giving up, causing a liquidity. Kind of not what you expect into the close, but that was the close. It was just like every seller just like pulled their order. So we might at least get. I got to watch the clock carefully now because if I get to 15 after, I got to be out of the trade. Otherwise, the prop trading firm will fail me on the evaluation I'm using. I don't trade on my funded accounts when I'm streaming. I'm not. I'm way too distracted to risk real money. So this is just an evaluation. I already finished with my prop. Nice. Okay. So I got my 10 points. I will go ahead and hold. I took this with 4. So let's see if we can get a little more. Because like I said, if this just starts to squeeze, my target is back up here. Let me mark it. I want to sweep the stops over the high. I don't know if I'm going to get there in time, but it makes sense that they see. It's kind of more clear on this. So see how they swept them out and then got people to sell and then fucked them. That's literally every single setup that works is catch someone doing something stupid and punish them for it. The hard part is not being the stupid people. Like, it's very easy and comfortable to join that, like, group of traders who just do things emotionally. Think like this has to go down. I'm just gonna short it. And it's finally falling, look, and boom. Stopped. Right? And then it's like, that's it. I'm shorting my whole account. You're not gonna go to high a day. And so if there's a chance that people are gonna freak out, I want to be on the other side of the trade because that's a good opportunity to be the systematic trader when everyone else is being emotional. So my stop does not move. So I could still lose this, which is the issue, the risk with holding runners. But because I'm confident that there were sellers down here, there's at least a partial chance that this actually screams higher. The thing that's going to get in my way is the clock, unfortunately. So I gotta watch the clock carefully and not stay in the market longer than I'm allowed. Because with the prop firms, you use way too much leverage to hold overnight. You can get back in after settle at 6, but at 6 p.m. Eastern, you can get back into the market, but you have to be out for settle. If you have a cash account, it needs to be relatively large to hold it over settle, but you can always just get back in. Like, there's, in my opinion, there's no reason to hold it. I mean, yeah, okay. The one reason is for tax purposes. I'm not going to go into it because I'm not licensed to talk about any of that stuff, but there may be benefits to holding positions related to taxes, but I'm not going to try to explain that because I don't want to give any advice that I'm not licensed to do so. So this is the most likely resistance point where all the volume was, remember? And we didn't reach it on this first try. So it sort of makes sense that we'd struggle here. Note there's a lot of volume. It hasn't closed yet, but even halfway through closing, we're already seeing that there's way more volume than expected, and it's after hours. So it's like someone's probably stuck and they know they have to cover. They just want to cover as low as possible. When those diamonds occur anywhere other than these first, like the swing and then the one after it, if they occur later than that in the rotation, if it closes with that diamond and it closes bullish, it usually goes at least 2 more bars. But not always in 15 minutes. So that's the one thing that I gotta be careful with here. Because of the slippage, I'm not yet recovered from that unfortunate stop. I would have been had I been stopped out where my stop was, but because I left the stop there for MOC, market on close, they like filled me like 2 bars lower than they should have, and I basically lost like an hour and a half. So it's fine. First of all, it's an evaluation, so I don't really care. But that was just a stupid mistake. that I wasn't paying attention to. And honestly, I very rarely trade the close, and that's one of the reasons, because that's just annoying. Of course, it could have gone the other direction, I suppose, and then I would have looked smart. But I truly just forgot that it was even a risk. Because that's how rarely I trade in the last 10 minutes. That there was a time when I would trade the close pretty regularly, but why? When you have a process that works literally anytime, then the only reason to do it is to demonstrate things, or to gamble, I guess. Please close with the diamond. Not like soon. So note we've closed, or I mean we're testing above this volume. So if we can't close it, I can probably just exit, because if we give up that volume and we give up this, it's not that it's bearish, but the chances that I get that screaming rip like in time is probably pretty low, because it means we need a pullback of some sort. But if we get over this volume and now it holds and we close this, it's potentially just going to squeeze. Maybe. This could also cause problems, but I assume that people who shorted down here put their stop here, so there's reason to go up there, collect that liquidity. That's what the market does. Eats stops. Come on now. I just hate that it's not moving when I'm on a clock. Not fun. So this dash could also cause resistance. We're gonna, if we do close this, it really should go, because we've also got an arrow here that got taken, and so usually when you recover, I guess technically it has to take this, because the Renko bar closes there, but the market actually continued higher and then fell. It opens here, but that's not time-based at all. Time-based, it opened at the close, but because it was a reversal bar, the opens line up. Whereas if it's a continuation bar, the open is at the close. See that? But when it's reversal, the opens line up. So what really happened is price went higher and then closed. It retraced the entire 15 ticks and went 15 ticks lower. And then it did it here again here, and then it went higher but couldn't go 15 ticks higher, retraced the whole 15 ticks, and then 15 ticks lower. So it takes some getting used to, but basically whenever you see this chop, 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 you do not want to be in the market. And what you want is to identify that when this happens, it's very common for price to go under. Okay. I guess I better be done with this. Please squeeze. See how they're rejecting that volume point? It could rip, but come on, hold it. They got to break over that dotted line. It doesn't look like they're going to do it. All right, we're up. Yeah, that's okay. Still positive, but on the trade, but unfortunately negative on that account. But like I said, it's just an eval. Okay, so let's see where I'm kind of curious if it happens, but it appears it's not going to. And the reason I exited is because first of all we have a clock, but second of all, this is the resistance, is where all the volume was. That dash right there ended up being where the seller was waiting. I thought he was going to be waiting up here, so I was holding, but he attacked here. And so as a result, we took that bar out. See how we got under it. And so now this guy who was trapped and was almost recovered is like, I don't like losing money. I thought maybe I'd hit my target, but they came back to my entry and they sold, so I'll be a seller too. And that's almost always how the market moves. It will be attracted to wherever there's volume or was volume. It'll test to make sure that if it's a buy bar like this, especially when it's out of position, meaning it's not at the right side of the channel. So, because remember, now my channel is a little bit different than Simon's, but just the way the market works, these shaded areas, if it's neutral, most of the volume is going to be inside here. That's not really like that, right? So if it's neutral, then this is oversold and this is overbought, right? Like I said, Simon doesn't like those terms, but that's what people understand. So if it's neutral, you'd want to be a buyer only under the channel and a seller only above the channel. So now that completely changes when there's momentum. When there's heavy momentum, go back here. I mean, I guess you could do this any of these, but this is a good example. So it was neutral. See how most of the volume was inside here, right? And those who sold above the channel brought price back to the midpoint, and those who bought below the channel got price to come back to the midpoint or higher. So that's what's supposed to happen when it's neutral. When it's no longer neutral, what happens is that those sellers who sold when it was well positioned, all of these sellers that were doing the right thing as far as expected value if it's neutral. But if it's not neutral, what you end up getting is price breaking through them, taking their stops, continuing higher, and then rather than returning to the opposite end, it returns to their entry. So that's the whole idea of like old resistance becoming new support. That's all that is. It's just people who were in a good position to mean revert getting trapped, and then price returning to their entry or their zone, and those sellers become buyers. So when that's happening, see here, when it's neutral, that's not happening, right? These buyers, it never became resistance during this period. And the sellers who sold here, 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 during this neutral period, they never got trapped, right? So it can't become support. But when they do get momentum coming in, now all of these guys get trapped, producing buy zones in the future on the pullback. So once you've identified the neutral period, it looks fun to buy the breakout, but believe it or not, like you could have called this a breakout and that one failed. This one looked kind of like a breakout. That one failed. This one looked like a breakout. That one pulled back, right? So usually it's like 30% of them work. Eventually you get the breakout. You break over both of these. So all these guys got trapped. They come back. This and this is your much better entry. It's funny though, because when you think about what the actual price is between buying this breakout and buying this triangle, you're buying higher, right? But it's actually, the expectancy is better. And I'm not basing that on these results of today. I'm basing it on the fact that if you did this exact same thing every other time, it occurred, getting a buyer above a seller out of position. Like the buyer in this case is out of position. They are not positioned appropriately on the channel. And the only one that works is this one. 2, 3, 4, 5. Maybe that's not a breakout. We'll say 5. We'll say 5. So yeah, like it's less than 30%, right? But one of them works. But now, if you just wait for all that, you skip all this, you miss this, but you're like, okay, now I know it's not neutral. Rather than thinking about this as overbought and thinking you should be selling, which again also worked, right? Ring, triangle down did give you a sell, and you can do that. But why, when you know that these guys got trapped selling down there? So you have pretty strong evidence that these old sellers are now buyers here. And so you could sell first and cover there, or just wait until they actually do show up. And when they do, you'll get algo signals at the right location. And this move, even though you're buying higher, this move has a much better expected value over time because your entry is in position. You're not buying up here above the channel. So relative to what price has been doing recently, this trader buying the breakout is taking the lower odds trade. And we have proof of this because we know over time most of the volume stays within the trend, right, within the channel. So do you want to be buying above the channel when you know most of the time, the majority of the time, it's going to return to the channel? Like, why? Just because you don't want to miss a move that only happens 30% of the time? Like, if you keep doing that and you don't have a way to discriminate between this and this and this, right? And you buy all of these, you could say, well, eventually it worked and I held all day and made 100 points. But how many times did you have to get stopped out? And what happens when it breaks out again and then fails and takes out this low? And now you've taken 7 stops in a row or something. It over time, it won't work. Not with futures. And unless it's trending. If it gapped and it trending like on a day like today, yeah, it'll probably work. But if you do that on regular, no, you will not make money over time. Instead, what I found does work is use the evidence that price likes to stay in here. And when it leaves and traps people, the next time it does come back into position, if they buy it, I can probably be a buyer here. And I'm still going to get paid basically at least half of what this guy took, right? Because he could technically hold all the way back if he didn't move his... Now, keep in mind, the other problem, people say like, oh, well, I wouldn't lose that much because I'll move my stop to break even. So I'm not going to take 7 stops buying breakouts. Well, guess what? You took like 5 stops here. You got in on the breakout. You got paid. You moved your stop to break even and you got stopped out. And then the market moved more than it moved when you got paid. So you got, let's say, 50% of the profit, but lost 6 times first. Whereas with my method, I'm skipping all of this. I'm not catching that, but I will wait until he makes the mistake of moving his stop to break even. And when they try to leave without him, I will take this one, because this move out and through the channel, after you have sellers trapped, all these guys are trapped, Getting under the channel now is going to be, and staying under it is really hard. Really hard. But getting over it should be way easier because it's imbalanced. You have more buyers than sellers. It's not neutral because the people who were selling are now forced to buy. So this move here after the bounce becomes extremely common. You can find it all over the place. And it works in reverse too. So like all you need is channels. I use the fib channels because they're a little tighter and I get more setups, but in Simon's room they use the Keltner channels. I'm not going to give you all the like parameters, but you can play around with it. We've perfected it, but that takes time and effort, and I'm not just going to give all that away. But you can see that here, remember the yellow line is where most of the volume was. Let me get rid of these real quick. If you don't know this already, it's a key element of the algo. So the yellow line is where most of the volume went off in that bar. So if we could hide the bar, like just like imagine the bars don't even exist, but look at the yellow line and see, does the yellow line stay inside the channel or does it stay outside the channel? And then the other thing to remember is that purple bars and pink bars, they're printing due to illiquidity, and as a result they don't have a lot of volume to begin with. So printing a purple bar down here under the channel, it's not that meaningful because it just means buyers gave up. And why would buyers give up here? Probably because they got stopped out, right? So if sellers now push under it, that's bearish. And what I expect to do, I would miss the breakdown. I would say all the buyers bought here. So if I can come back up there and I'm inside the channel when I sell, or above it, even better, I'll do it. But instead, what happens is there were no sellers down here. It was just buyers giving up. They fought. Buyers fought back. Sellers fought back. Then when they went lower, no sellers. They got a triangle down on a purple bar at the low. Very, very, very dangerous under the channel for sellers to do that. Buyers then push. We get triangle up with a plus sign, and it touches the bottom of the channel, and it lifts. And so now those sellers are going to get trapped again. Right? And this works on any time frame. So I would rather be a buyer here rather than being a buyer here. And then if this works, well, now I can look for pullbacks back into this range. So see how there were sellers in the green range above the channel? It was neutral. They tried to make it bearish. They failed. Mean reverted. Comes back up to resistance. Resistance now becomes support. Am I inside the channel? Somewhat. I'd prefer it lower. But this becomes your better buy rather than this, and this. I don't want to buy the breakout. I want to wait for the breakout traders to move their stop to break even and get stopped out. Then I'll trade it. Am I technically trading higher than them? Yes, I'm getting in higher. My average is not as good, and I'm being more patient, but my win rate is better. And then if I didn't get this one, I'm waiting at the bottom of the channel for a purple bar to get beat by a triangle. Up. Right? And then here, is it neutral? Is the question. Is most of the volume, where the yellow line is most of the volume in the middle of the channel? I'd say no, it's not. It's not neutral. There's bullish momentum. Is that momentum growing or fading? Well, are they getting farther and farther away from the channel and failing to break through it, except for with purple bars? Or are we doing this where it tries to get back in, tries to get back out, tries to get back in, tries to get back out, and then takes out the lower channel with a non-purple bar. Well, now it looks more like a failure. And so now, if you want to short down here, once like on a pullback, it makes a little more sense. Like you might be able to short this and it might work. The problem is because it's been bullish, your target is here where these guys shorted and got fucked. That's your target. That's as good as you're probably going to get. See that? They are forced to buy here. And now those buyers are in position to lift it back up, right? They're no longer up here above the channel. They're actually below the channel. So you don't have to buy immediately, but if this continues to hold and we continue to get triangle up above purple bar, it's just not going to be able to go any lower. See that? So now it's neutral. The yellow line is primarily inside the channel, right? But I know that behind me, there's sellers trapped. But above me, there's buyers trapped. So what probably happens? Well, we have to look at the higher time frame and say there's a whole lot more sellers than buyers trapped. So if I want to buy triangle up, I can, particularly if it got above a purple bar. So the most aggressive trade for me would be getting long on those triangles because this support held. But the problem is that these trapped buyers are going to act as resistance, right? It's just the reverse of this. So they got they got above the channel, but they didn't break out. And so now these sellers are positioned to sell. And so they do. And they get real bars, not just purple bars, underneath. So now, while it can bounce, it usually won't right away. We are going to need some consolidation and neutral conditions, or run into an area like the green where we had sellers trapped and then we bounced. So that old resistance can become new support. Where were we? Yep, like that. So it becomes new support. Your most aggressive trade is buy this with a stop down here. What are you targeting? I'll move back up here. That one fails. It's aggressive. It never got back into the channel. You are buying in position, but it looked bearish. You had bear bars below the channel, and you are basically saying this is a likely spot for it to bounce, and a buyer showed up here. I will give it a try. But is it going to work 60, 70% of the time? No. Now we go under the channel some more. And this time they lift here, and now it's neutral. Now this time they just ripped it up because this guy got trapped. But what I would like, well, it's okay to buy this in the same sense that it's okay to buy this because it's purple bar with the triangle up above it. Purple bar, triangle up above it. When the triangle is pink, the entry triangle, or it has a plus, it's a much better trade. So between these two, the second one, not just because it worked, but this one is more likely to work than this one because it's pink. So that's your more aggressive trade. Your less aggressive trade is to see if this guy can get trapped, which he did, and then see if it becomes support in the correct side of the channel, and avoid buying that or this because you're not positioned very well, and a lot of the times it's going to do this. Will it always do that? No. But there we go. So it came back into this zone. Let me write it again. Eventually you can just kind of see these things. You don't have to draw them out. Right? He got trapped right here. The breakout trader buys. His trade works. So what does he do? He puts his stop at break even. Price goes up, runs into the trap buyers from above, comes back underneath the channel, should be looking bearish. It got a real bearish bar, not purple, underneath the channel. That should be pretty bearish. And it would be if there weren't sellers trapped underneath, and if the breakout buyers didn't move their stop to break even, because they also become sellers that help that bar form and aren't, because they're aggressively exiting. It's a market sell, which is the same thing as someone market selling to short. So when this holds, like if it keeps going, it's bearish. But we want to be selling at the top of the channel, not the bottom of the channel. So in this case, when it doesn't keep going, but instead we get big volume, triangle up, plus sign, more big volume. Look where we're located. We're at the bottom of the channel. Old resistance, new support. Do we have odds? Yeah. Our entries here, our stops here, our targets here. 1 to 1. That one fails. It probably gets you 10 points and then rolls. And sometimes that's going to happen. Comes back in here. It does the exact same thing. Just this time. Well, I took this trade. This was the... no, I didn't. I took the aggressive breakout. Yeah. Like, not the smartest trade, but I took that. And then it did market on close, flushed, tried to go. That would have been acceptable entry. I skipped it. I don't remember why. Oh, I remember, because I have a T here. So technically, this is not a good entry because there's a T here. And if you don't get the VPOC, or at least a close that's not pink, above him, he can act as resistance. And so he does. They pull back, but they clear him, right? But then they respond with a pullback. And then we got trap back in, triangle up. Triangle's pink. Triangle also has a plus, and we're well positioned in the channel. So this, out of all of those, the one I took early that stopped, that was the worst choice. I took it to demonstrate something, but it wasn't, I didn't have good risk reward. It wasn't a good choice. This one didn't trigger and failed. And then, so nothing happened here for buyers. And then they trapped this guy, apex trap, got a good entry signal here, and we got paid. Oh, they did end up printing the big volume. I just didn't want to get my, I didn't want to hold through settle, but they did eventually push it. That's cool. Okay, I'm going to take a 2-minute break, grab something to drink, use the restroom, and then I'm going to come back and we're going to review the day, kind of like I just did with the last couple minutes, but I want to demonstrate on the 24 tick and the 15 tick, kind of how things played out, particularly to investigate a little bit on some of these new setups that I introduced this week and last week, and see where they worked on a trend day versus where they failed. And I'm hoping that by doing this, I can learn a little bit about when to use them and when not to. So Yeah, give me 2 minutes to use the bathroom, grab something to drink, and then I will be back and we'll do that. All right, be right back, folks.
All right, let's right away go back to live before I forget, because I forgot that yesterday for a bit. Okay, so first of all, if it was the beginning of the day, the first thing we always do is evaluate where we are on the chart, because there's going to be certain areas that are just going to be way easier to trade than others. While you can use the algo anywhere, the places it's going to work the best is when your entry signal aligns with a higher time frame location that we already expected, like what we call unfair pricing. So, in other words, an area that has not been thoroughly auctioned, whether that's due to being a anomaly, single prints, or the previous days. Like, I'm not going to go into it. You can, if you come into the room, you can learn all that stuff. If you know how to use the profile, that's pretty much where you find all those. But today we had an overnight or morning pre-market gap, both, I guess, a small overnight, and then in the CPI, I think it was, came out. Was it CPI or PPI? I think it was CPI. Inflation information, let's say that, came out less hot than expected. Still going up, but not going up as much. And the result was an instant rise in the market, despite the fact that overnight inventory was long. So, and what I mean by that, if you're not familiar with Jim Dalton and using the market profile, is if you look at where yesterday's range was, which was, like I mentioned yesterday, was primarily inside the range of the previous day. And remember, it was the 15 to 1175 voodoo range level on Friday that was acting as resistance. No, sorry, Monday. Overnight, we pushed up one more, 15 to 43.25. Then that one acted as resistance. So that kind of testing a level, rejecting the level, testing the level, rejecting the level, shifting up and testing the next one, and then rejecting it. That's very normal in neutral to bullish markets. Generally, you can kind of look over time, and if you see that where, like, we test, reject, and then note here, even on Monday I talked about this, well, maybe it was Tuesday that I pointed out that, like, you got underneath a low, so you made a lower low, sweeping the stops of all these buyers who bought up here. So breakout buyers, like we talked about before, put their stops underneath lows, they get stopped out, and now the market can now continue beyond their initial entry, because those stops kind of become the fuel to get sellers committed at the lows. It force them to get fucked, right? Make them make a mistake, and then they emotionally short on the way back up, fueling a push to the upside. And then here, so that was Monday. Tuesday, we had an early morning drop, but that drop was unable to take out that low. And again, overnight inventory was long. And if you have overnight inventory long, in other words, you're trading above the settle price of the previous day, the assumption is that wholesalers are going to sell this, those on a higher time frame who have, like, books of orders to fill, like bigger institutional traders, they're going to take advantage of those higher prices generally, and, like, profit take, right? And so the pullback is very natural. Where it becomes important is to watch where it bounces. And if you look on Tuesday, it tested underneath 15-11-17, and couldn't close even a 15-minute candle under there, and then immediately retraced. So see this illiquidity here and here and here, where you go, like, at least one, if not two voodoo ranges down, and then revert
all the way back up. That's what people think about when they're in trend days. They think that that's going to happen. It doesn't happen during trend days very often. When you see these V reversals is during neutral markets or on bullish trending markets when you go counter trend. So notice when we go counter trend, there is energy to push us back up. But if it doesn't break over the high, it returns to re-auction. No liquidity. There's no sellers down here. Well, there were. You can see the increase in volume, but it wasn't more than this. So buyers come in and save it. And those sellers were not very committed because, as you can see, they just immediately reject it. And then once again, they trap buyers. And now they've got very little energy because it's overnight. They sweep some stops, come back here and establish 15-180-25 as like a visual level. And the high frequency trading algos that my belief anyway, is that they draw this on purpose. They bring it back to that level as like a measured move so that when the real traders come in and they can see them sell here, when price comes back up there, they can trust that these guys that bought here are going to be sellers. And it gives them as market makers a pretty consistent profit, regardless of where the market's going after that. So I've mentioned it before that's I think why we get this kind of like rigid movement with the voodoo range levels, but that doesn't really matter. The good news is that you can use them to your own advantage. But like here, for instance, bounced off it as support, failed to get over it, returns to this one for support. They draw it very clearly, so everyone has it on their level on their chart, I mean, and then they crush it. This one looked pretty clear. They test under it. It comes back to the one they wanted to sell it, and then they sell it through this one. And so now, once it gets under that one, it comes to this one, which was not it was well auctioned, but you can see there's not a lot of interest here. There's no one defending it. This 15-117-25. Back here, they drew it overnight. They like made sure that they were buyers there, basically, so that everyone had it on their chart. And then there was zero interest on either side. They just let it go, right? In both directions. So it's basically just like drawn there to make sure people have their stops there, and then they can take advantage of it as market makers to be a buyer when those sellers stop out. And same thing here. So the illiquidity here at the voodoo range level that used to be like appeared to be defended, if the defense happens with very low volume, particularly overnight, and then the low liquidity event where we auction right through it without any defense, that means that level, it's basically, like I said, you can think about it like they're how can I explain this? Like those algos, those high frequency trading algos, they want price there. They are making sure they are making money. Let's put it that way. They are making money as long as price gets there. And so they support it. And then when price, they can trust that people will put their stop there and they will make money. And so see how they do it here? They support it and they're able to, suggesting that like the sellers here weren't really that committed because it just like was able to bounce right off a level that wasn't really like visually important to any people unless you had the voodoo range levels lined on your chart. But it was definitely important to the market makers because they didn't let it pass it. Well, now that it's actually done this, well, now they know they can make money there. They just need price to come down there again. And so it does. And now they get an illiquidity event, get to make money. So you don't necessarily know. It's not like it's like every time it tests, the next time it's not going to work. It's unfortunately not quite that easy. But oftentimes, if you see them like defend voodoo range level, and if you look to the left and it like wasn't very clear, like it might have been this one, there was definitely buyers here, but it wasn't like exact, right? Chances are that's probably needing to get re-auctioned. That the market doesn't like this. And so when it comes back, we want to watch. We don't have to do what the market makers do, but we want to watch what happens when they make their money. Are there any real sellers down there? Or are the only sellers the ones who know that there's stops sitting under here? Once those stops get cleared out, if there's no more sellers, it's just going to be illiquid all the way back up, and it'll retrace this entire move most of the time. And it happens at the tops too. But see here, tested over it. It's not like the very next one did it. That was the close. But remember, this was the open. So where they really count is overnight. This. They are drawing that level for a reason. They plan on taking advantage of traders who are going to put their stop there, because it used to be a level that they were watching, but no one else is. Now everybody has it on their chart. Hope that makes sense. So now when it goes through there, they are happy to be sellers there because they know people are selling. And then back here, the one that got flushed with illiquid action, like just passed over it because it wasn't that important. It was just an overnight level that happened to be like measured. When we come back there, when they buy it again, nobody wants to be selling because these guys are still trapped. So the thing to see is that if you have a chart that looked bearish, what you should see is increased momentum and increased volume as you go lower. And when you get these like exacting levels that get swept like this, you don't want to see a full retrace of the entire move, because what that basically means, if you're bearish, up here it made sense. That was all bearish. This is not bearish price action. I know it's a lower low, and you might say that they're lower highs. It's not bearish. This is accumulation. They are getting underneath this low for cheap contracts. And if you go far enough back, it'll make sense why, but it doesn't. Don't worry about that. You don't need to know where this is. You don't need to know that this is the level to buy. That's not how most of us make money, not consistently. You don't need to be the buyer that gets in here. You need to recognize that you don't want to be the seller who's selling the breakdown. As long as you know that, then you can be confident to mean revert here. So again, overnight before Tuesday, they drew this line pretty clearly. Not surprisingly, Monday night, overnight. Not surprisingly, they sweep underneath it. They come back up to it. There are sellers waiting there. Where are they going to go? Right back to this one. No sellers underneath. Why not? It's not that bearish. It's auctioning down there, but there's not a lot of momentum. There are probably buyers who are interested in accumulating more contracts down there, and they're just not letting it drop. So they when you see that full retrace, particularly after a either a failure to reach a previous low or a sweep under a previous low that gets you a full retrace, that means that this whole area is basically fair value, and that nobody's on a higher time frame, nobody's really defending it. No one is interested in putting a lot of money on making a directional decision here. They either already made their decision and it hasn't changed, so maybe they bought down here or sold up here. And so this whole area in here is basically just fair. As long as it doesn't get down here, there's not an imbalance. And as long as it doesn't get up here, there's not an imbalance. So the result is all of this is choppy and difficult to trade, with lots of traps and stuff. So, but anyway, what I was getting to is that once you see that full retrace of the move, just like we saw here, if this low after that retrace can't get taken, and then this low, retrace, they can't take that low, it's not bearish. Don't be bearish. And I who cares about macro and stuff? If you're day trading, just don't even, you can pay I mean, you can know, but don't let it bias you into thinking that like all of these lows are going to get taken out in 15 minutes or something. Like it's just not going to happen. There's too many people with higher time frame viewpoints that have like advertised that they're interested down there. And I know technically like economic changes could like shift that, but until it does, until we actually trade down there, then all we need to know is that somebody was selling down there and they're very offsides. And so until that changes, it can keep going up. There's literally no such thing as like overbought, particularly. There's always a time frame higher that's not overbought. So while you might see mean reversion, you don't it doesn't necessarily mean that the entire market is bearish. And it's a really easy trap to fall into. So anyway, that didn't get taken out. This early morning low didn't get taken out. Everybody in the trading perform room, I know Ronnie in particularly mentioned we're going to high day, and he was right. And many of us caught a trading here, and it, even if you didn't do any, like this was hard, this illiquid, like, because it's in yesterday's range, that's hard trading. You don't need to do that. You can actually skip all this, but the easier trade was the sweep and the retrace. That was sometimes the afternoon is harder, but yesterday the afternoon was easier. So then overnight, inventory is long. See how it's going higher, and they're failing to get, this is settle, they're failing to get under the settle price. So if it was neutral, since we already know this is all fair value, and you can draw the volume profile if you can't see it, I'll show you. Makes it pretty easy on TradingView. You go over here, fixed range volume profile, and then since this was bearish here, I'm looking for the moment that kind of changed. So like anywhere in here, or you could even start it back here where it starts to sort of, because like this was like the last move down, and there's less momentum here than there was here. So really we should start it here. And if we measure all the way to the end of the day, well, I guess you wouldn't know where it ended. So let's do it where the setup was. So inside the value area is going to be choppy and difficult to trade. And the closer you are to this VPOC, the volume point of control of that fixed volume profile, the more stops you're going to take, because it's going to sweep those highs and lows easily, because no one's willing to defend them, because there's not enough meat on the bone to return price to VPOC, which is what most traders are doing. They're buying here and selling it here, and selling here and buying here. So if you're buying here, sometimes you're going to get up here, but sometimes you're going to get stopped first. And so once you draw it, you can sort of see that by the end of the day, and I talked about this in my stream too, we had finally broken out and we closed well above the fair value, meaning basically that this auction is complete. We've confirmed that there were buyers down there. We've trapped enough shorts to push out of the area. And so now what you really want to do is find the last time before this. Hold on, that's not right. I just got to find it. So we can move this back to include this one. So this is high momentum, but then this last little leg, starting the green one, was divergent. You didn't have very much volume on that last push. See that? So we're going to start it there, and then we're going to stretch it. Well, first of all, we clearly closed above that fair value. But now, let's go to the morning before CPI. So if, regardless of what you think about the economy and all that stuff, what should be crystal clear is even if I include the value area of this entire zone from Thursday the 6th till this morning, we have once left the area, they defended. Where does it go? To take out all these lows, which it did. Now, when buyers show up, where does it return to? VPOC. Then swing low, tries to go lower, right? Because high, lower low, lower high, lower low. If it's bearish, we should see increased momentum here. Instead, complete retrace. Why? Because the VPOC is up here acting as a magnet because it's not bearish. Came up to value area high, rejected. Came up to value area high, rejected. Each one of those times coming back to this voodoo range level. And then, not surprisingly, since that happened overnight, they sweep it. They take out this low, but they can't take out this one. So now, on a higher time frame, we've started to trend up and accumulate. So they break out. They tried to come back in overnight. They couldn't get through and hold under that settle price. And sellers start to panic. Even before CPI. They were already recognizing that we are stuck, and the chances that I get out back at VPOC are getting less and less likely. If we would have had a bearish CPI, what should we expect to happen? Some of you are going to say, we make a new lower low. And the answer is, that's usually wrong. Not always. Sometimes it does do exactly this, right? But most of the time, when we've already trapped people down here, see here, it was just a divergent low. Like, it was bearish. It was a divergent low so that they consolidated. They tried to break out a few times, and it failed. And so now they're going to take off the low. This was not bearish. They had a chance to be bearish, and they failed to keep being bearish. So if it's a bearish CPI, what happens is we return to VPOC of this consolidation area, and we probably take out this low, the afternoon low. But unless we take out previous day's low, it's really hard to be bearish. And if we did take this out and we swept under this one and then retrace the whole thing back up to VPOC, guess what? It's going to be bullish again, regardless of macro. So if you're looking here before CPI and you're thinking overnight inventory is long, so I want to mean revert, well, that would make sense if you didn't have economic release coming out or if it was bearish. But when the economic release comes out and you get this reaction, just assume that this is already done. Your bearish ideas are wrong for the time being, and you're not coming back here. Because to do that, not only would you have to retrace the entire reaction, which does happen sometimes, but then you'd also have to take out this breakout that they couldn't even do with zero volume overnight, right? And then you'd have to expect that value area high wasn't going to hold. And you'd have to expect, which doesn't make any sense, that VPOC wouldn't act as support, even though we've clearly left the area and trap sellers below it. Normally, the place where the most people, the most contracts were done, once you leave the area and come back to it, it's the most common place for buyers to actually be waiting to accumulate more. Because keep in mind, someone, me included, was swing trading here, saw this move and got long, and then saw this move and should have added but didn't. So when it comes back to this spot, what are they going to do? They're going to add to their long. And their stop is going to stay down here. And that's what I would have done with my swing. But instead, you just stay long and take whatever you got. But a lot of times when the market starts to pull back into fair value after leaving it, that actually acts as support. It also works in reverse. But just don't get too fixated on the idea that the overnight action needs to reverse. That's just not the way it always works, especially if there's econ or a Fed speaker or something. So in the morning, we had this breakout, and we should have known right away that yesterday's settle price is probably support because it was overnight. And the other place that's probably support is overnight high. So if we mark that, that's overnight high. It would make sense to return and retrace some of this since everybody was long overnight. Someone's got to take profits, right? But they're going to eventually start to accumulate their long position because it looks bullish on a higher time frame now. So when they pull back, well, they don't, you don't get much, but like this is always hard. But a lot of people see this and they're like, rising wedge, it's gonna all fall back down. But even if you got to overnight low or overnight high, you wouldn't even take out the entire econ. And look at that shaved bottom candle. Like the moment this came out, every algo that's written to buy or sell based on those reports, every one of them bought. Nothing. The only ones selling were hedging before it. By the time this was here, everybody bought it. And then where did the first pullback come to? Just some measured move probably. And then where did the second one come to? A new voodoo range level. No, we couldn't close over that voodoo range level. It's not bearish. It just means rest. And once it holds, it's probably going higher. Same thing here. Can't break over it. Can't close over it. Probably needs to rest. But as long as this low holds, it's not going here. And as long as this low holds, it's not going here most of the time. Continues higher. Now we have to watch volume because look at all these sellers in here. Half of them are buyers, more than half probably. But it's a doji that had bigger volume. This is the open. Than the pre-market, right? Which makes sense. So this was the attempt to take this back, and they couldn't even retest that voodoo range level. So not bearish, but that level should be watched, this. And if this one gets taken out, the momentum's clearly slowed, and now we want to wait to be a buyer until we get to some of these important levels. So they continue higher. They actually did close a 15-minute above this, and I think a 30-minute as well. But then they pulled back. Note this volume is nothing close to the volume that was there when we were climbing. So this should be easy to absorb. See how it's decreasing despite price going lower? They're already absorbing it, and we still have not come back and tested this. And after breaking this out, they haven't come back and tested this either. So it's still bullish. There's the big one. So this one took everyone's stop, right? Including mine. I took a stop there too. It took this out, and now this is where it got tricky, because now the thinking should be, well, they went too high. Everyone got too long. You can see that volume was actually decreasing as we went higher as well, so it was also divergence. And now they've got big volume here, but this volume was divergent to this volume. And remember, this one was a doji. So there were quite a few buyers in here that just got stopped out. And so to be bullish, we either need to retake that. I guess it should be not yellow. Retake that or go back to a key level, bounce, and then hopefully trap sellers. They go lower. Note how volume's decreasing as they go lower. But this is just consolidation now. Volume increases as they lift. Why? Because we're retracing, we're coming back into the zone of this first 15-minute candle. But note, we can't close above it. Now we do. But volume is lower. So this is not just going to go straight up, but it's probably bullish because they came back, retraced. It's probably a fib. Yeah, 78.6 or so, 80, and bounced with decreasing volume as they dropped. And it did not reach overnight high. So this is not bearish on the big time frame. This is neutral on the like hourly or whatever, but still bullish based on the previous days. And so we should expect some chopping here to get through this. It would be really bullish to rip right back through here, but normally it's going to go chop, chop, chop. They rip right through it. So they don't even blink. They close this above the low of this doji with all the volume. They try to get underneath it and can't even close the 15-minute back below it. And 15,475 continues to act as support, just like it did after the economic release, confirming that whatever people's bias was here has really not changed. This was just like a liquidity grab under this. And they ripped it up. Now, I would be surprised when I see this to see it immediately go to the highs, but we've all seen it happen. Usually, this big volume, like retrace candle, it can get fully reauctioned in one move like this, but oftentimes it's not. Oftentimes you get like a bull flag and then a breakout. But this time they just ripped right through it. They closed above it, but not above this lower high on like a 5-minute chart. See how they couldn't close above there? So now they're going to retrace. How much will they retrace? Well, take a look at the voodoo range levels. This one acted as resistance. We broke through it, tried to come back to it, but didn't test it. This one broke through it, came back to it, tested it, lifted. So this is the most likely one, 15,432.25. They test it. They can't close under it. And see how they're drawing this as an important resistance? So that breakout probably gets us over this. And that's where we are right now. So I would be less bullish if we get a big drop down here and we give back 15,400, let's say. If we get back under 15,400 now, then I'm going to assume that we're building this and filling it in a bit. I would expect like eventually these single prints get taken back. If we can't take this, that pullback here, since we retook it, it suggests that there's a lot of sellers that got stuck here and they can just take that out. So overnight, I would hope for a gentle pullback maybe back into 15,400, but for buyers to show up in here, somewhere around here, and not to spend a lot of time or energy volume underneath here. And I want to see buyers waiting here. But like I said, if they do take this out, and especially if they come back in and we find resistance, it's gonna bull flag, like, and take out these single prints. And then what I really want is to be a buyer down here. That would be great. But I don't know if we get that chance. If I had to guess, I'd say it maybe sweeps this low and then rips up without taking this out. But I think that because there's so much volume here. But if they fail to take this and they put volume under this, maybe we get a flush, which I would love. And like I said, the single prints should get filled then. And then the overnight range should get tested. And I'd be a buyer on a test reject of like 15 to 11. Okay, so that's what we're dealing with the candlesticks, right? So now let's quickly run through the algo. Let's do it on the 24 tick just because it'll go faster. So pre-market, we're not going to worry about because there's no way I can trade. Look, this all happened within 0.5 of a second, right? We can still find important levels, but I'm not going to like analyze the setups because there's no way I could physically take them. But you can see, for instance, that this support held. And like I talked about before, buying here is out of position on the channel. You should be generally be looking for sells on the top of the channel. But when you obviously don't sell when they can't even stay inside the channel. So instead, if I like that level, if they break out, I just want to wait for a pullback to that level. And then if they defend it, I'll get long there. It's the same level as that. The only difference is I get paid here while the breakout buyer tries to get paid here, moves his stop to break even, and gets stopped out. That's the difference. So I don't want to be the breakout trader. I want to watch him lose money. And then I want to see someone take the contracts he sold. And if they do that aggressively, I will follow him in. So, sorry, my phone keeps going off. I just want to make sure. Oh, I see. It's a market. And then remember, the yellow line is the VPOC of the individual bars. So that's where most of the volume is within the bar. And notice what happens. Like I said, there's no way I could trade this really. But look what the first little high looks like because it's kind of interesting. So we know, or I know, that ring, the yellow ring, followed by red triangle down, that often starts a pullback. But in this case, we were so close to this old resistance, new support, that it didn't have anywhere to go. And so what happens, since it's bullish, it just rips right back up. And if you remember what I said when we were looking at the candlesticks, it's all the same. The only difference is that this is like super zoomed in, looking like within a candle, but all the mechanics are still the same. So when we see them pull back to old resistance and it acts as new support, and the result is we retrace the entire move here, that is capitulation. And what that tells me is that this is likely fair value, meaning it's going to be the hardest place to trade breakouts or breakdowns. And instead, I want to be a buyer at the bottom and a seller at the top, generally. Okay, so that's kind of interesting. And then remember, the green is big volume. and something I mentioned in yesterday's stream, is that when you see an apex, a triangle, and then diamonds beyond that, especially the very next bar, but beyond that, if they pull back, if it's bullish, like I wouldn't buy this because it's so out of position, but if they pull back into the channel, preferably the middle of the channel or the back of the channel, and we get blue dots, it's usually buyable as long as it's not bearish. So here, apex, triangle up, that one has the diamond. But then we get another diamond up here, right? So what I want at this point is a pullback, and then I want them to recover this because that's where all the volume is. If we stay under it, if this becomes resistance, you can sell it like that. But bigger picture, it's bullish, so why sell? Instead, I could either use the old resistance, new support, and see this is a great setup because you've got blue, which is usually a sign of exhaustion, unless it's trending in that direction. And then we got T's at the bottom, which are tripwires. And that means if I get a triangle with a close above them like this, especially when they're purple, it can rocket. I want the down move for that tripwire trade to be more than 3 Brinko bricks. I'm finding that when we have very small rotations like this, with the T in the right place on the rotation, but not in the right place on the channel, it's at the top of the channel, even though it triggers with a triangle up above the T-bar, it runs right into resistance, takes my stop, and then goes to the target. So to avoid that, the 2 things to watch for when I take that trade is look to make sure that the T is coming after more than 3 bars. So 5, 6, 8. Big rotation down, ending with T's. And that big rotation took me to the back of the channel, or at least not the top. The middle is okay. And then that way, I could even potentially take that trade counter trend because it will filter out a lot of these stops that I was struggling with earlier. So I had already filtered out so I don't get as many T's, but there's still a lot of them. And like I said, to get it to trigger, you need a triangle bar to close below the T. So like this T, or beyond it, I should say, behind it. This one does not close behind the T, so this is not a short. But this triangle closes above the T. There's T here too, but it closes above both of them. So that is a buy. And then you can see when they show up, and this is something I talked about in the other, I think it was last week, when they don't produce the triangle, so T, pull back, but no triangle down, and instead bull bar up, if it's trending and I get a blue dot there, that is often a safe place to buy. If it's not positioned well in the channel, then I need to wait for a pullback and can buy that. That will only work with the trend. You don't want to do that counter trend, you're going to get smoked. But it's a good continuation trade. But anyway, even if you took, because just like purple bar, getting beat by a triangle up is a good trade pretty much all the time. The inverse of that is pink bar getting beat by a red triangle down. And that works as well. Just have to remember that anywhere that was resistance is going to be support. So you don't want to take it if you don't have good risk reward, because the stop in that trade needs to go behind the apex. So like here, I guess this has got a long enough wick, I'd probably put it here. But like this one, I'm going to put the stop here. Some people put it here. I like it here. I think it's safer there. And you're usually going to get at least one bar, if not more. Okay, let's see. What else do we have here? So let's go to the actual open, which is here. So like I said, all that happened really fast. Note, once we opened at 8:30, right there, if you look at where the yellow line is it inside the channel, above the channel on bull bars, or below the channel on bear bars? All the way through here, it's inside the shaded channel. See, even this one could not get the VPOC above it, meaning momentum is not increasing. It's not bearish, but it's, if you've been rising like crazy, the only way you can keep it moving is either correct, pull back, or correct in time by like holding, sweeping low and running again, or you increase momentum and push higher. Those are basically the choices. The most unlikely situation is like an inverse V. That is not something I'm ever going to expect in a trending market. It happens all the time in neutral markets. But if the bigger picture is bullish and I'm at the highs and I see the yellow line can only get above the channel on bars that close bearish, but when they close bullish, even though they have strong algo signals on them, the yellow line is not getting above there. See, this one, it got up there and then price pulled back, right? It also can't get below the channel, so it's not that bearish. But the easiest thing to do, as soon as you notice that, is just don't trade any of that, because all of these signals will just waste your time and energy trying to find trades, because your resistance is here and your support is here. So why even take that trade when I can just wait for price to for like the range to expand? So if I know the higher time frame is bullish, and I know we've moved up a lot, like I said, my choices are wait for a correction in time, watch for a correction in price, or look for momentum to increase. So here, a correction in time would be something like neutral, apex, apex trap. Now this one stopped out by like 2 points and then re-triggered here. And sometimes that happens, especially in the first 15 minutes. I did not take that trade because I don't usually trade in the first 15 minutes. But the trade that worked right away, purple bar, triangle up. But having these 3 bars in between them, rather than just 1 bar in between, makes it less likely to work. Okay. Other than that, the other thing you might notice if you've been watching my recent streams is you can always watch the yellow dots and the blue dots to see who's in control. If you can get the VPOC, the yellow line, on a bear bar like this, not a purple one, but like a stone colored one, if the VPOC of that bar is below a blue dot, chances are you're going to rotate lower. You might retrace first, but that high is probably set and not going to get swept. So here, you could not get the VPOC below it. So if you want to trade this, the entry is here, but then your target is here. And then you can see the yellow ones. The lowest yellow one is here. No VPOC above, no VPOC above. The one time we do get one is pink, which actually makes this triangle down a good short because we got the pink one over it, and then the very next bar was bearish with VPOC going higher. So the pattern, again, is find a, for the short, is find a yellow dot, fail to get a bullish bar with a VPOC above it, get a pink bar above it, and then VPOC goes up, but price goes down. Then wait for the triangle, and then you're in either here or on the pullback, because the pullback's very natural. And usually this stop will not get hit. And then on the bull side, it's just a one rotation scalp. It doesn't say that we're going below a day or the trend has changed. It's just a scalp. So on this side, here I said we did not get it triggered, but then here, bear bar couldn't get under it, right? We went a little lower. If we would have gotten triangle up here, it's a long. We didn't. We got a bear bar. But then look what's underneath it. Purple. I'll show you again. Blue dot, or even these ones. Doesn't matter. It'll end up being the same. So on the rotation down, the only one with a VPOC below it was a bullish bar. Then this one lifted. And then purple, purple. This one is the other one. Okay. So now we got only purple bars below the blue dot. And so now we're waiting for triangle up. Long. Because the blue dot was defended despite getting purple bars underneath it. And you can see this VPOC is on a pullback, so we're not going to worry about this one. Plus, it had a yellow dot. So if you didn't see the defense, yellow dot, push above yellow dot. Now this was only pink, right? So you're not ready yet. And if you got triangle down, it'd be a short. But if you've broken it and then it pulls back and you get blue dot, as long as you've got room to resistance, that can also be a long. But you have to be careful because if you do that counter trend, you could technically take this short and be totally screwed. So the only way you can buy blue dots or sell yellow dots really consistently is with the trend. It needs to be like a continuation trade. Otherwise, you're trying to beat them or trying to defend them. But the entry is usually on a triangle, not on the dot. The only time I can enter on a dot is if I'm playing with the trend. So here it lifts. Now, again, look at the channel. We got a VPOC above the channel on a bull bar. VPOC above the channel on a bull bar. It's probably bullish. Once you see that, you want to calm down with the shorting. And I'm going to look back and say, who got trapped? Did anybody get trapped? Well, where were the sellers? They were here. You can see that little red dotted line, or dash, dot, dash. That's where the sellers are. So I need a VPOC that's not pink on a bull bar to trap them. This one's below it. This one's pink. This one's a bear bar. This one's pink. This one's a bear bar. And now we fall back under it. There's no new pullback and lift. It's probably not going higher until it collects some more liquidity. It's just unable to increase momentum because the only thing they can put above this trap seller is pink bars. So even though it's above the channel, which usually means breaking out, that breakout is weak. And I've talked about this before, but it's an easy way to know if you should be buying the breakout or waiting. This works over here too. I didn't point it out because it's kind of confusing, but if you've got a high, the dotted line, dash line, The VPOC gets to a pink bar, then it gets above it, and it breaks down. It's just another reason to sell this, because that breakout has failed. It doesn't mean it's bearish, but it needs to recollect liquidity. Where? Usually under a swing low. Now it's collected liquidity. Now it can break out, and it breaks over this, but it can't get VPOCs on non-pink bars above it, meaning that breakout is pretty weak. So where's it going to go? Well, probably here to collect liquidity. We didn't get the little flag on this pullback, so that one's probably not going to hold. If it does, it could be an explosive lift, but we would need a triangle up now to be bullish, because this at the high, just like this, is a sign of a pullback. So you don't want to buy green bars or diamonds or anything, only triangles once you've gotten a sign of weakness. Okay, so it pulls back. So I'm not doing anything here, but you technically could sell the triangle because you've got pink bar beat by triangle down. Nothing wrong with that. I just don't do a lot of counter trend trading in the first 15 minutes or whatever, because this is what happens. So I'd expect it to pull back, but this held. So you could technically buy that. Purple bar, beat by triangle up. Now notice where you are. You're at the top of the channel. So if you don't take trades at the top of the channel, don't do it. Wait for this to get trapped back in. I don't remember if that happens or not, but that's the better trade. But that one works. You get VPOC above the channel, it's probably bullish. I would doubt that we're going lower than this. And then if I want to look to see if this breakout is likely to work, I need VPOCs above that, which hasn't happened, but I haven't gotten any pink bars up there, so there's really no sign of weakness. We just need to wait. I'd say long. Okay, triangle above it, VPOC above it. This is the only breakout that's in my playbook. That I can buy. Other than that, I'm not supposed to buy above the channel. This is iffy, but it's technically still inside. This one's clearly outside, and that one I will buy. Now, I made the mistake of doing this at the end of the day, and it failed. The win rate is not 50%, but when you think it's trending, it can work. And this one works. But you can see that it's not easy. You need to put your stop underneath a real support. So for me, it's a blue dot, and that one would work. It's usually 2 bars, which means for this to work, for 1-to-1, I need to get 2 bars. So if I've got like a resistance above me or something like that, I'm just not taking those breakout trades. But if I don't, I can take it. Now, something I talked about yesterday, and I messed this up later in the day, maybe more than once, the dashes that come at the beginning of a rotation, like this, like this, like this. It's the very first bar, and it's got a white dash, and they're in position. The dash is above the channel, which is where I want to short. If I'm bearish, I can short them. But if there's trapped sellers below me, like we talked about before, where people aggressively sell to the left, maybe? Where are they? There they are. I was like, where's the aggressive seller? They aggressively sold the star. That has to be my target. So I can sell this, but I'm getting out here. I can sell this, but I'm getting out here. And then if it's with the trend, I don't have to take those, obviously, but it does work. If it's with the trend, I can be a little bit more liberal. But again, it needs to be positioned correctly. So it would need to be a dash, a white dash down here, which I didn't get any. all the white dashes are poorly positioned, like this, and then you tend to get a pullback. White dash, pullback, continue, pullback, continue. That is a very difficult and not consistent entry. The only time that even has a chance to work, in my experience, is when you get VPOC above an aggressive seller, like this, and it's got a dash. Sometimes this just screams higher. Usually it pulls back 1 or 2 bars and then goes. So you don't have to buy it. You can buy the pullback. You don't even have to wait for this star to close. You just see the dash at the top. You know it's out of position, but it's broken out. See how it's blue? That means that it's divergent. There's more aggressive sellers than aggressive buyers. It's not bearish if you see that, unless you can get VPOC below the low. Usually you'll get a triangle down below that, and that can be a problem. But if you look here, the VPOC, the yellow line, the all-important yellow line, it gets under there and it lifts. So what you can do, and what I did, what I've been doing, I know where that bar will close if it's going to be bearish. We're alerted to that when the bar's still live. And in this case, it would be like, let's say 50. So I can put, because I've already gotten triggered in up here, I got the VPOC above this bearish aggressive trader, and it's bullish. I know that I don't want to be bullish anymore if I get this delta divergence and then a triangle down, and I'll see that the triangle's possible when this bar is live, and I'll also see where it closes, which is like here. So I can put my stop there and enter anywhere in there and risk 5, let's say, points, and then take profit back at the dash, because if anywhere is going to fail, it's going to be there, and then leave the rest as runners. And it works really well. See that? Now, that'll also work in the other direction. So here, the orange, I know this is during, what's it called? The CPI, so it might not work the same, but I can still demonstrate it. So this orange means there's more aggressive buyers than aggressive sellers. It's definitely bullish if I get a triangle up above it, but it's got to get a VPOC above it. The yellow line needs to get above it. So see how yellow line gets above it, but they don't print a bar, and the triangle was actually before it, and the VPOC did not get above it. That makes this a better, what we call a super trap. It's a pretty good trade. You put your stop up here, usually 7 points, enter here, take 7, hold runners. It works better if you're trading with the trend. But the best bars to do the super trap on that I've found are the ones with a apex sign, the flag, and delta divergence. Because you know if you get that triangle up above it, it's dead. If this triangle up gets the VPOC above this high, it's going to scream higher. I'll find some more examples of that, I'm sure. But that's another interesting trade. Okay, so where were we? We were here. So pull back, you can buy it, lift, and you can just be long for as long as you want. Note, we get T up at the highs. If you get a triangle down under that, it's usually going to correct a bit. You don't get a triangle down. Instead, you get a blue dot. Because it's trending, you could technically buy. Plus, it's a blue bar, which means divergent, which means if I can't get a VPOC that's bearish under this, I'm not bearish. So if I don't want to buy right here, which kind of sucks because you're buying right into resistance, instead, I know my stop needs to go one bar below that, basically like here. So the closer I get to that line, the easier it is to make money to the long side. Now here you didn't get really much of a chance, but the idea would be buy one of these pullbacks. Because as long as this low doesn't get beat by a VPOC, it's going to go higher, especially when it's trending. But you'd have to be prepared for testing under it. See, you need to get a VPOC below that. So even though this looks pretty scary, it technically has not taken you out yet because VPOC has not gotten under it. And then, not surprisingly, it bounces. So the safer way, what you cannot do, and I made this mistake today, is you cannot put your stop a few ticks below the divergent bar. It will likely get hit a lot, especially really close. But even here, like half a bar, boom, stopped. It's the divergent bars are not necessarily a sign of strength. They are a sign that the area, the range of that bar is contested, but that buyers like won the contest, but sellers have not necessarily given up yet. Hold on. Let me just answer this. Okay. Yeah, so got to be careful, but like I said, it's a great spot for a super trap trade where you wait for this low to get taken out and then enter, putting your stop at the place where the next bar would close. That's the better trade. Otherwise, if it's a really, really heavy runner like this, like huge momentum, this one doesn't look as good because it's only one bar above it. But see how we've gotten like multiple bars now above the channel and we can't even get to the back? It's bullish. And usually that the low of this channel is going to hold, or maybe the gray line, which is kind of like a moving average. So when I see this show up and it's the second bar to get VPOC above the channel, yeah, it's probably just going to keep going. I certainly don't want to be a seller. And it's got an X on it, which is also a sign of aggression. But the higher odds trade is to wait for the pullback, get in the correct position on the channel, see if they take it, and if they don't, you can buy it right there. Then take profit here and hold runners for the continuation with your stop down here. Works pretty good. All right, so now here, remember I said starting at the divergent bar here, that this is where we were able to get VPOC above the channel and above these aggressive traders. So that's the first point where I can say pretty confidently this is not only bullish, but increasing in momentum. That area should act as support at least once, if not twice, if we get a pullback. And the same thing happens here. Aggressive trader, stars and X's. We get a VPOC above the high on a bull bar that's not pink. Chances are this guy's trapped and he's going to be a buyer when we return to his range. That is a very consistent entry. Does it have to break the high? No. It can get stuck if these guys don't continue buying. So it's just a scalp. But it makes sense to hold a runner because sometimes it's going to just go parabolic. I don't have a way to know ahead of time which ones will and which ones won't. That I wouldn't share it if I did. But I will confidently take it. The other thing, see the orange at the low here? When it's bullish and you get these heavy volume into the low, heavy delta into the low as well, usually getting above him with VPOC, which I think technically happens here, usually that's going to explode. And then what I would expect is if you draw a line here and the first bar to get VPOC above them, if that bar fails and you get a triangle down below this, it's probably bearish. Otherwise, I'm looking down here for a trap back in bullish. So I don't have anything to do up here really, as far as I can tell. Ring, triangle down, pretty good. Usually if this holds, the triangles down that are parallel to that will continue to work. Look at all this volume at the highs, looking pretty strong, aggressive. But it's been bullish, so these guys are trapped. So I don't expect them to just like fall apart, but sometimes they do. Note they did get an aggressive trader underneath this, so they need to immediately trap him. But if we can get a triangle up above this T, I'll buy it. Otherwise, it's starting to look bearish. And now I know it's bearish because they would have had to pull this back, and now I won't even be able to get back to this T. So now the character has changed. One setup that I didn't see live is if you find the biggest delta at the high, so this is the range to the high, biggest delta in the range to the high is here. If you then pull back and they try to recover it, and they try hard enough that they're making more delta than they had at the high here, if this bar, which is the plus, if that bar is beat, it's bearish. And I missed that. But that makes this a good sell. And once you've gotten that, you can actually plow through some of these old supports, because now what that means is that plus bar is now the resistance. So if I can get a pullback, which doesn't work as you don't often get them on the way down, but that is what you want to see. Plus I've got this purple line, which is divergence, and during a trend day you're going to see it a lot, and you don't always want to care about it. But if you can get a divergence with a triangle down like this and it holds, it's probably bearish. So this one did not hold, it got beat, so not bearish, but divergence remained and we got another triangle. This one held. So now yellow dots, stars, pullbacks that get aggressive like follow through, triangles down, they're all going to be good sells. Like that's way at the bottom of the channel, so I don't love it, but yeah, I'd prefer it to come up here. Let's see if it does. Yeah, see, I don't really want to sell that. And this purple bar triangle up is actually a long, because this is old support, old resistance, new support that we're breaking over. And we can do the exact thing we did before in reverse. We can say, can we get under a aggressive buyer? Well, there's no stars or X's to the upside except for these. So can we get POC below that on a non-purple bar? No. So while this move looked really bearish, this old resistance appears to be holding as new support. So usually this triangle's good, but my target is back to this trap buyer. So I buy this, and I think I did, and target that. And I got 10 points, and then I got the sell. Star, triangle down. So you could just sell this because of this trap buyer. So even though it's trend up, we came back to old resistance, we held it, we got a buy, it lifted, which is what it should do, but now we're on the backside of the up move. We've gotten lower highs, lower lows. We've trapped a buyer, gotten underneath them. They tried to get them back, and they got stuck right here. So the fact that now, if this star shows up way up here, no. But when we can't break through this trap buyer, I'm shorting this. Boom. Right? Easy money. Okay, now because momentum is so strong, see how they can't even get back into this channel? Very strong momentum. You can technically sell yellow dots. You can sell triangles. You can sell stars. You can sell diamonds. All of them. Pretty consistently. One of them's going to fail. If there's no wick on the dot bar, it's very dangerous to sell if it's underneath the channel. So this one, not great. This one's okay, but it's really far from the channel, so it's dangerous. You can't really put your stop behind it. You'd have to put your stop up here, above a dot, and that's a big risk. So I might short this, but I'd like to think I wouldn't short these. But then once it pulls back, triangle down, I mean, there's really no reason not to sell it. Just like you had up there with the dashes at the dots, I'd prefer these to be in the right position. And if you want to wait to see if this level gets held and then short it there, that's not wrong. Like that. So this is a better sell than this. That's my opinion. Now, Simon, my coach, points out that the plus bars that show up under the channel are usually pretty reliable buys. This one failed. This one worked. Once I get one of those that works, I'm cautious about selling. Because if this holds, it's bullish. Plus, I got the dash at the beginning, just like this, but it's positioned correctly. So again, if I mentioned this before, up here, when you get the dashes at the top, above the channel, you can usually trade back through the channel. Well, here's a bull, and so my target is back here. And so that's another way to catch that. But this is technically a short. There you go. So for Simon's trade, the trade and perform trade, which is a good trade, but it's not going to work in straight down momentum, is wait for the plus or a triangle with its pink and buy it and target 1 to 2 bars. This one fails. This one works. And then you're long again. And that one fails. And then here's another one. Works. 1 plus. Right? So maybe 50-50 when you're trading against the trend, but pretty relatively reliable. If you want to improve that, only take it if there's a purple bar underneath your triangle. So this one you take, no purple bar, so skip that one. No purple bar, skip that one. Purple bar, beat. You get paid. All of a sudden, you've got a much better win rate. And then the other thing that I do is the T bars. If there's a T anywhere, it needs to be beat. Here's the T. Triangle did not beat the T. I'm not taking this. Here, triangle beat the T. I can take it. The dashes, like I said, even if they're out of position, tend to also act as resistance. So here, that makes this not a very good trade and to enter on to the long side. And it makes this my exit and a potential reversal. Because, like I said, you got the dash. It then puts you in position on the channel, and you got triangle down. And then T was respected, and you're at the top of the channel. Makes sense to short. Now here, Simon's initial entry, triangle up with plus, works for a big lift. There's no purple bar right behind it. So you'd miss it if that was your criteria. But for me, I just need a T that get beat. So for me, I'm long here. T got beat. No dashes to stand in the way. The next resistance for me is this T. If it didn't get taken out, it got taken out. That one's done. So it's the dash. That one got taken out. That one got taken out. There isn't any. So I'm holding runners. Boom. All the way back up to yesterday's, or no, what's that? Like volume area low from like the 5th or something. Star. No, we got above the channel with a non-pink bar. That's usually bullish. We've also beaten a pink bar. I'm sorry, a yellow bar with a non-pink bar. That's bullish. My guess is that this low is going to hold for the time being. This one here, after we beat this. And I'd like to see triangle up to get more long. But if I got long here, I want to hold runners. Right there. Long. Purple bar. Long. Oh, wait. Did we not beat the T? That might get in the way. We beat it by a tick. That's a long. Boom. And that's where I got paid. That right here. I was basically done at 11:30. So now look, we got above the channel again. Above the channel on a bull bar. It's probably bullish. Above the channel on a bull bar. It's probably bullish, right? Momentum's actually increasing. So if you initially see this, and I used to, if you look at this, big drop, wiggle, 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 and then return to opening range low, and you're like, I can't wait to short this, you're probably not doing very well on those trades. A very easy way, if you have the tool to know that, is find the low. How much delta was there? Was it heavy volume, heavy delta, or was it divergent? We saw up here at the high, the high, the highest bull bar had low volume, low delta. I said, once you get above that on delta, which was here, the T, if you get below it, it's bearish, right? So we said, short that diamond or that star, because it's bearish now. Same thing at the low. So where's the low? It's this one. Heavy volume, heavy delta. And nope, we did not beat it. It's the heaviest one we've had. All the way through here, these sellers that are trying to push it further down, they're not using more energy as the one who put this low in. So they still have a chance to continue lower. The low of day is not necessarily in, but it is a location with low volume node. That's what the yellow is here. And this high volume, high delta, usually needs to see continuation. So let me show you some other spots where that happened on this drop. This is the first one. Well, actually, this is the first one. The diamond. High volume, high delta. High volume, high delta. All of these. Right? What happens after those print when they continue? Here's the delta. Here's the high for the rotation where that came out. So at that point, that's like the swing low, and this is the swing high. Does the swing high hold? Yep. Okay, delta increases, volume increases. Where's the swing high? It's here. Does that hold? Yep. Diamond. We'll say it's slightly increasing delta. This should hold. Yep. High delta, high volume. Now, where the swing high is here is probably way up here still. So then this one, same thing. That one's divergent, so that's kind of weird. But even if we said this was the swing high, that holds. Still bearish. Look what happens here. Big delta, big volume. It's clearly the swing high is here for that rotation down. If it's going to still be bearish, we can't lose that swing high. We can't put volume above it. Right now, still looks bearish, right? They defend it. It's okay that we put price above it. We just can't push through it and add volume. We certainly can't see it being used as support. So far it looks pretty good. Uh-oh. It gets stuck right there. No delta, no volume. And what do? They put volume above the swing high. It's not bearish. You don't have to buy it here. But if you were short here, like even with puts, like just get out. Stop being bearish. Start looking for longs if you haven't already. Like I said, trade and perform algo got us long here. But even if you didn't know to get long there, if you just stop shorting once you see this, well then there's all sorts of ways to catch this. Purple bar, triangle above, that's an entry. Beat the T with the triangle, that's an entry. Big volume, big delta, where's the swing low? Right here. If that holds, it's bullish. Boom. Stop being bearish. Right? This swing low is probably going to hold after that. So now pullbacks into the spot where sellers are trapped. Here's the highest one I can find. Stars. This is support. I realize that this looks awfully high for those who see this as bearish. But I'm telling you, order flow says if this was bearish, this doesn't happen. And this doesn't produce this when it's bearish. So even though we're not at the low, in my opinion, just like we saw at the highs, where we knew it was bullish and we trapped sellers We got over them. People bought the breakout. And I said, you don't have to buy this. You can wait till we come back and force those old sellers to be buyers. Well, now they did. And now you just made money. Right? And we're not expecting this to get retested. So can we keep buying this level? Hell yeah. And now you just made as much money as you want. And now we're back to where we were when this is where I ended and started where I stopped trading the performance accounts and started trading the eval. And I missed a trade somewhere. Where was the trade we missed? It was before the pullback, yeah. The trade we missed was it this one? Might have been. I thought it was a triangle above a purple bar. Oh no, it was this one. So I started the stream here at noon, right? I had just finished. Exited this early, I guess, and missed this entry, I think. Oh wait, maybe it was this one. Purple bar, triangle up. 14. Maybe that's when I started the stream. Because I was like, I thought I caught most of this. But look what they did at this high. Green. Big delta, big volume at the high. Just like they did at the low, only in reverse. Do they get a delta above this? No. Where's the swing low? Right here. If it's still bullish, we should not develop volume below that. We get big delta, big volume, volume below. Uh-oh. Now it's resistance. Now, does it mean it can't break? No. But it means buyers are going to have to do some work here and recover this. And then remember what I said about the divergence, the blue, that they make for very good super traps. So here, we know it's bullish as long as we don't get a triangle or a VPOC below that, making even this bear bar a good entry as long as you can put your stop down here. So you might have to do that with kind of small size. But this one, pull back, that's a good entry. You just got to put your stop down here. And you get a scalp. But like I said, now we break under that. And for the moment it's bearish unless we recover him. So now this, big delta, big volume, and the divergent bar, this was divergent as well. We got VPOC below him, and it's clearly not bullish at the moment. But we can return to a trap seller, such as this or this, and we might bounce. There we go. Purple bar, triangle up. Comes back up to our trap buyer. Freeze him. Now he's free. Okay, because we got volume above him. So now it's not bearish. Bigger time frame was bullish. We were bearish for a moment. Pulled back into trap sellers. Freed or recovered the trap buyer, sorry. And now triangle up can be buy. Right there. Nope, we get a big seller. And we trap him. And honestly, you could keep buying this because we've now gotten back above him and developed a swing low, put in big volume. So this should continue to hold. This higher low should continue to hold. This high's done. I'm very unlikely that they beat that. Nope. The only way would be to take out with VBOC one of these lows. This one did not get taken out, only on a purple bar. This one did not get taken out. Most likely this high is gone. So there you go. How to make a lot of money in future trading. if you want to join us in the room and check it out, email my coach, Simon. Trade the letter N, word perform at gmail.com. Ask for a free week in the room. Tell him I promised you one. And if you like what you see, or if there's something you want to learn more about, just DM me on Twitter or say thanks publicly if you want at Red Ben Trader. And I hope to catch you guys probably next week.